Welcome back to the channel. Today's video is a must-watch, especially if you're keeping an eye on Apple, AI, or the future of big tech investing. Dan Ives, the global head of tech research at Wedbush, just dropped a bold statement on CNBC. He said, and I quote, "AI is the elephant in the room, and Apple's missing." That's a heavy claim. He also says Tim Cook's $600 billion playbook is just the beginning. Now that got my attention, and it should get yours too. In this video, I'm going to show you the full clip of Dan Ives on CNBC's Closing Bell, where he breaks down what's really happening behind Apple's recent moves, their relationship with the White House, and how they might be falling behind in the AI race. And after you see the clip, I'm going to give you my own detailed breakdown and reaction, exactly what I think is really going on behind the scenes. Then, to wrap it up, I'll break down 2 high-growth AI stocks you need to have on your radar right now, especially if you're looking for smart opportunities in this fast-moving sector. So if you only watch one video today, make sure it's this one. Watch it all the way to the end. Before we dive in, hit that like button. Let's see if we can hit 1,000 likes on this one. Share it if you find it valuable. And if you haven't already, make sure to subscribe so you never miss the next big financial update. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. All right, let's get into it. Here's what Dan Ives had to say.
Dan, you first. Best day for the stock since May. Is this, in fact, the start of something bigger?
Look, I mean, it removes clearly a big overhang in terms of the view Apple and Cook were on the wrong side of Trump, right? I mean, they were on the bad side relative to over the last few months. So it's taken that sort of lift here, you know, in terms of tariff exemptions. You play nice in the sandbox. This is going to be a good press conference. And I think that removes that overhang. But I think the bigger issue continues to be the elephant in the room in terms of AI, and that's missing. And also everyone understands that they will not be producing smartphones, iPhones in the U.S. This is more about AI. It's a fairy tale that they'll produce smartphones in the U.S.
So the relationship was bad, as you suggest, so money can buy me love. It can, in fact, buy me love. Tim Cook just has to spend a little more money, up his commitment, and now everything's just rosy again?
Look, I think the initial reaction is the big worry here is what was going to happen with India, and obviously you talk about tariffs, given what's happened in China. I mean, right now it's moving goalposts for Apple. They're trying to figure out iPhone 17, where they actually produced that. And it's clearly the first buddy, it's been Jensen and NVIDIA. Cook's sort of been iced out. I mean, he's really been on the outside looking in. He needed to do something to get into the good graces of Trump. It's a first step. But where it gets tougher is the reality that this is more initial AI investments and some of those initiatives. It's not going to be about iPhones. iPhones, in our opinion, will not ever be produced in the U.S. because you'd be talking about $3,500 iPhones.
Steve Kovach, you want to take us through the anthology of this relationship because it has had its ups and downs. We have wondered more recently whether these two men were on the outs. Jensen Huang went to the Middle East. Tim Cook did not. He got called out, in a sense, during that visit, if you recall.
Yeah.
But now maybe all is well when you write a big check.
It could be. And by the way, this is not the first big check this year Tim Cook has written, including $1 million of his own personal money towards Donald Trump's inauguration event. So there's plenty of money going around here, Scott. But we can even rewind to the first term because it was Tim Cook, Scott, who actually wrote the playbook with how to handle Trump. If we rewind all the way back to 2019, when he gave Trump that big tour of that factory in Texas that was already pre-existing and already making Macs. Just a few weeks later, they got those tariff exemptions from President Trump in his first term. Now we're seeing this all play out again, just an extra $100 billion in commitment towards the United States. And it appears, at least as Megan Cassella just said, that the payoff here is that relief in India, which just got its tariffs doubled. I do want to dig into what the $600 billion actually means, though. This does not mean, Scott, that Apple's going to start building $600 billion worth of stuff and factories and so forth here in the United States. A lot of this spending was likely already baked in. They're counting just about everything they can count, saying they're supporting the American economy, whether that's paying app developers selling their software in the App Store, or whether that means paying suppliers like Corning and Qualcomm to use their products within Apple devices. So there's a lot of ways to measure this. We know the president wants to see stuff being built here. I don't know if he's necessarily going to get that, so it's going to be really interesting to see. I'm expecting about an hour's time for more details out of Apple, how this $100 billion is actually going to be spent. Is it going to be spent on manufacturing or investing in the supply chain here in the United States, or is it more of that nebulous stuff that we can't really track? We know what the president wants, but we also know that the president likes to be flattered by big headline numbers, and he got one today. That might be enough of Cook the politician playing the game with Trump and getting what he needs out of the president this time.
Dan Ives opens with what he calls a removal of a big overhang, and he's talking about the political tension between Apple and Donald Trump. For the past several months, Tim Cook and Apple have essentially been on the wrong side of Trump's favor. They were clearly outside the circle of influence, especially as Trump cozied up to other tech leaders like Jensen Huang of NVIDIA. Apple, by contrast, had been getting iced out. Now, Dan makes it clear that this latest move, Apple's announcement of a massive $600 billion investment in the U.S., seems to be more of a political maneuver than a purely economic one. It's like Apple's version of playing nice in the sandbox. You stroke the president's ego with big numbers, and in return, you get policy benefits, like tariff exemptions or favorable treatment in global trade disputes. And as Dan puts it, this feels more like a press conference strategy than a long-term shift in Apple's production model. But here's the kicker. Ives brings up the real elephant in the room, and it's not tariffs, it's AI. Apple has been visibly missing from the AI hype cycle. While companies like Microsoft, NVIDIA, Meta, and others are racing ahead in generative AI, Apple hasn't been a central part of the conversation, and this, in Dan's view, is the bigger issue. He doesn't hold back when he calls the idea of producing iPhones in the US a fairy tale. According to him, the logistics, cost, and scale simply make it impossible. If they even attempted that, we'd be looking at $3,500 iPhones. So despite all the political theater, Apple is not bringing iPhone production stateside, and that's not going to change. But this move isn't really about production at all. It's about optics and positioning. Ives frames this $600 billion announcement as Cook's first step toward getting back into Trump's good graces, and possibly to secure smoother ground for future Apple supply chain moves, especially as they look beyond China and into India and other markets. Now, Steve Kovach jumps in with some very important context. He reminds us that this is not Tim Cook's first rodeo. Cook essentially wrote the playbook for how to deal with Trump back during the first term. Think back to that 2019 factory tour, where Cook gave Trump a walkthrough of a Texas facility that had already been in operation. It was a smart, calculated move. And shortly after that, Apple got those tariff exemptions. Fast forward to now, and we're seeing the same playbook play out again. Cook cuts a big check, Trump gets a big headline, and Apple possibly dodges some of the regulatory or trade bullets. And as Kovach notes, this isn't just corporate money. Tim Cook himself contributed $1 million of his own personal funds to Trump's inauguration event. So clearly, he understands the cost of access and how to strategically spend for leverage. But now, let's drill into the $600 billion headline, because this is where Kovach pulls back the curtain a bit. He warns us not to take that number at face value. That figure is likely not a new $600 billion investment. Instead, it probably bundles in a lot of what Apple was already doing, from paying US app developers, to buying chips from Qualcomm, to using glass from Corning. All of that spending now gets repackaged and presented as a patriotic commitment to American economic growth. So yes, it's flashy, but it's also nebulous. It's hard to track what's actually new here, and how much of it is just clever accounting. Kovach also makes a strong point about what the president wants versus what Apple is offering. Trump wants to see factories, he wants to see iPhones made in the US, he wants jobs. But Apple? They're delivering a headline and calling it a day. The $600 billion sounds huge, and that might be all Trump really needs. At least for now. But again, both Ives and Kovach are making it clear. This isn't about iPhones. This is about Apple's standing in the AI race, and Apple, at least for the moment, seems to be behind. This moment also signals a shift in Apple's political calculus. With supply chains being restructured post-China and India becoming a more crucial manufacturing base, Apple needs strong relationships with powerful people. And whether you like Trump or not, Cook knows he can't afford to be on the outside looking in anymore, not with India doubling tariffs. And not with AI changing the entire landscape of consumer tech. So where does this leave us? From my perspective, Dan Ives is reading the situation with sharp clarity. He's not buying into the headlines. He's digging into the strategic chess game that Cook is playing. It's not about factories, or really even about US jobs. It's about geopolitical maneuvering, AI competitiveness, and Apple doing what it needs to do to stay in the game, especially as other tech giants build deeper and faster AI capabilities. And 𝗣𝗟𝗏𝗧 reinforces that message with historical context and grounded skepticism about the real impact of the investment figure. So, here's the bottom line. Apple just made a major political move, not a manufacturing move, not a technological leap, but a strategic repositioning. Whether that's enough to catch up in the AI race remains to be seen. But one thing is clear. Tim Cook is playing the long game. What do you think? Is this just PR and politics, or is Apple quietly setting the stage for something bigger in AI? Drop your thoughts in the comments. I'd love to hear your take on this. If you got value from this breakdown, don't forget to like the video, subscribe to the channel, and hit the bell so you never miss our take on the biggest stories shaping the markets. Now let's dive into the 2 high-growth AI stocks to buy now. ARM Holdings, ticker symbol ARM, the hidden architect of the AI universe. While the world obsesses over flashy AI models and the latest gadgets, there's a silent force powering it all from behind the scenes. That force is ARM. First up, ARM Holdings, ticker ARM. If you've been following the tech markets, you've probably seen their name pop up more and more, especially as AI takes center stage. ARM is the global leader in semiconductor design, powering everything from smartphones to AI applications. Their blueprints are the foundation for the chips inside billions of devices we use every day. Unlike chipmakers like NVIDIA or Intel, ARM doesn't manufacture chips. They design the blueprints and license them to giants like Apple, Samsung, and even NVIDIA. This means ARM's influence stretches across the entire tech landscape, quietly shaping the future. This model is brilliant. ARM collects royalties on every chip made with their designs, without the cost of factories. They don't have to worry about the massive capital expenses or the risks of manufacturing, yet they profit from every device sold. Over 280 billion ARM-based chips have shipped. ARM gets a slice of every one. That's a staggering number, and it keeps growing as more industries adopt their technology. Their dominance in mobile is unmatched. 99% of smartphones run on ARM. Whether you're using an iPhone or an Android, chances are the processor inside is built on ARM's architecture. Why? Their designs deliver top performance with incredible power efficiency, crucial for AI at the edge, like phones, cars, and smart devices. In a world where battery life and speed matter, ARM's technology is the gold standard. AI needs powerful, energy-efficient chips. ARM's decades of expertise make them the go-to for companies building AI hardware. Their designs are optimized for both performance and low power, which is essential as AI workloads become more demanding. But ARM isn't just about mobile. They're breaking into data centers and cloud computing, challenging Intel and AMD's x86 dominance. This is a massive shift, as cloud providers look for ways to cut costs and boost efficiency. Cloud giants like AWS and Microsoft are building custom ARM-based chips for their servers, saving billions in energy costs. These companies are betting big on ARM to power the next generation of cloud infrastructure. ARM's growth story is twofold, expanding their licensing into new markets like automotive and IoT, and rolling out their advanced ARMv9 architecture. The automotive and IoT sectors are exploding, and ARM is right at the center of this transformation. ARMv9 is built for AI and machine learning, offering a leap in performance and security. Companies pay a premium to license it. This new architecture is designed to handle the complex workloads of tomorrow, from self-driving cars to smart factories. The result? Accelerating royalty revenue as customers adopt ARMv9. Every new device that uses this architecture means more revenue flowing back to ARM, fueling their growth. The more companies use ARM, the bigger the software ecosystem, creating a powerful network effect and a deep moat. Developers flock to platforms with the largest user base, reinforcing ARM's dominance. Yes, ARM stock is expensive, but you're paying for dominance and a scalable business model at the heart of the AI revolution. The premium reflects their unique position and the sheer scale of their opportunity. Risks exist. ARM must keep innovating, and global supply chain issues could impact revenues. The semiconductor industry is fiercely competitive, and staying ahead requires constant investment in R&D. But ARM isn't just benefiting from AI, they're enabling it. Their technology is the backbone of the AI revolution, making advanced computing possible everywhere. They're the picks and shovels of the AI gold rush, selling the blueprints everyone needs. In every wave of technological change, it's often the toolmakers who profit most. Even their biggest customers, like Apple, can't walk away from ARM's technology. The entire mobile ecosystem is built on their designs, making them indispensable. Recent earnings show surging licensing and royalty revenue, especially from ARMv9. This momentum is a testament to their strategic vision and execution. Demand is accelerating, with management bullish on data center and automotive growth. These sectors are just beginning to tap into ARM's potential, promising years of expansion ahead. The automotive sector is a huge opportunity. Modern cars are data centers on wheels, and ARM is capturing market share fast. As vehicles become smarter and more connected, ARM's chips are becoming the industry standard. Investing in ARM means betting on the spread of intelligent computing everywhere, from sensors to supercomputers. The world is moving toward ubiquitous intelligence, and ARM is at the core of this shift. Every new device or server using ARM's design adds to their bottom line. The more connected our world becomes, the more ARM stands to gain. ARM's IP-driven model scales with minimal extra cost, making them the undisputed king of efficient processing. Their business grows without the need for massive new investments, driving profitability. The stock may be volatile, but the long-term trajectory is up. Short-term swings are inevitable, but the underlying fundamentals remain strong. ARM is the toll road for the tech industry, capturing value from trillions in end-market devices. Every time a device is sold, ARM gets paid. As ARM v9 adoption grows, so does their share of the value. The next wave of devices will be even more reliant on ARM's advanced technology. With a market cap of $142.45 billion, earnings per share of 75 cents and revenue of $4.01 billion in 2024, the company boasts strong financial fundamentals on paper. But despite that, its stock took a sharp dive of over 15% in early August following its latest earnings report. The cause? Disappointing guidance for the second quarter. ARM projected EPS between 29 cents and 37 cents, falling short of what analysts had expected. The outlook was described as soft, triggering a wave of concern among investors. That concern quickly translated into a sell-off, with several analysts slashing their price targets and amplifying the decline. But not everyone is writing the company off. CEO René Haas has been vocal in shifting the narrative, emphasizing what he considers to be the underlying strengths of the company. Haas pointed to an aggressive investment strategy aimed at strengthening ARM's position in the competitive semiconductor industry. While earnings guidance may have missed the mark, the CEO's focus remains on the long-term play. One of the biggest developments out of ARM is its bold move into chip development. Historically, ARM has focused on licensing its designs to other manufacturers. But now, the company is taking a different route, investing directly in making its own chips. It's a significant pivot aimed at enhancing competitiveness in a market largely controlled by giants like Intel and AMD. The idea is to carve out a larger slice of the data center CPU space, a sector expected to expand rapidly thanks to growing demand from AI and cloud computing. These shifts reflect ARM's effort to remain relevant and capitalize on the next wave of growth in semiconductors. Analyst reactions have been mixed. While some see the long-term potential, particularly in the data center space, others are skeptical about ARM's ability to execute effectively in such a competitive landscape. The company's ambition is clear, but turning that ambition into measurable performance will be the real challenge. For now, investors are being urged to watch closely as ARM navigates this transition period. With strategic bets on innovation and energy efficiency, there's a case to be made that ARM's current turbulence could lay the groundwork for stronger long-term growth. For investors seeking high-growth exposure to the AI revolution's foundation, ARM is a unique opportunity. It's a rare chance to own a piece of the infrastructure that makes modern technology possible. It's not a speculative bet, it's an investment in the architecture powering the future. As the digital world expands, ARM's relevance only grows. ARM's entrenched position makes it a strategic player in 21st century technology. Their influence is felt in every corner of the tech ecosystem, from the smallest sensor to the largest data center. Keep a close eye on ARM. As the AI universe expands, the hidden architect behind it all is only becoming more essential. Next up, MongoDB, ticker MDB. This company has been making waves in the tech industry, especially with its innovative approach to data management. MongoDB is redefining how businesses manage data in the AI age. By offering a more flexible and scalable solution, it's changing the game for developers and enterprises alike. Traditional databases organize data in rigid tables, great for structured info, but today's world is flooded with unstructured data. Social posts, images, sensor data. This unstructured data is growing exponentially, and businesses need a way to harness it effectively. MongoDB's document model stores data in flexible, intuitive documents, perfect for the messy, fast-changing data AI needs. This flexibility allows developers to adapt quickly to new data types and requirements. This makes building and evolving applications faster and easier for developers. They can iterate quickly, respond to user feedback, and deploy updates without the constraints of traditional databases. AI and machine learning thrive on vast, diverse data. Legacy databases are a bottleneck. MongoDB's flexible model unleashes data for AI. This enables more sophisticated algorithms and better insights. MongoDB has evolved into a full developer data platform, with Atlas as its flagship product, a fully managed, multi-cloud database service. Atlas simplifies database management, allowing developers to focus on building great applications. With Atlas, developers can launch databases on AWS, Google Cloud, or Azure in minutes. MongoDB handles the backend. This multi-cloud capability ensures high availability and disaster recovery. This cloud-based model creates recurring revenue and massive scalability. As more businesses move to the cloud, MongoDB is well-positioned to capture this growing market. Atlas is driving MongoDB's explosive growth, making up a growing share of revenue. This growth is a testament to the platform's value and the trust businesses place in it. MongoDB's moat, developer love. It's consistently ranked among the most wanted databases. This strong developer community is a significant competitive advantage. Developers adopt it for small projects, then it spreads company-wide, leading to major enterprise deals. This organic growth strategy has proven highly effective. Their land and expand strategy is fueling rapid growth. By initially targeting small teams and projects, MongoDB can quickly demonstrate its value and expand its footprint within organizations. MongoDB keeps innovating, adding features like vector search, crucial for generative AI apps and advanced search. These innovations keep the platform at the cutting edge of technology. By integrating AI-ready features, MongoDB is positioning Atlas as the default data platform for the AI era. This strategic positioning ensures that MongoDB remains relevant as AI continues to evolve. Switching costs are high. Once a company builds on MongoDB, migrating is complex and risky, making customers sticky. This stickiness translates to long-term customer retention and recurring revenue. As customers grow, so does their spending on Atlas, driving high net dollar retention. This growth in customer spending is a key indicator of MongoDB's success. Competition is fierce. Legacy giants like Oracle and cloud providers like Amazon all offer databases. However, MongoDB's unique approach and developer focus set it apart. But MongoDB's cloud-agnostic approach lets customers run on any major cloud, avoiding vendor lock-in. This flexibility is a significant advantage in today's multi-cloud world. Their singular focus on being the best developer data platform lets them out-innovate broader competitors. This focus ensures that MongoDB remains at the forefront of database technology. MDB is a classic high-growth tech stock. Revenue is surging, driven by Atlas adoption. Investors are taking notice, and the stock's performance reflects this growth. They're investing heavily for long-term leadership, sacrificing short-term profits for market share. This long-term vision is crucial for sustained success. Watch their path to profitability. Improving margins show strong underlying economics. As the company scales, these margins are expected to improve further. The stock is volatile, but the long-term trend is clear. Data is the new oil, and MongoDB is the refinery. This analogy highlights the critical role MongoDB plays in the data economy. The database market is over $100 billion and growing. MongoDB has only scratched the surface. There is significant room for growth as more businesses adopt modern data solutions. This is about disrupting a massive industry with superior technology. MongoDB's innovative approach is challenging the status quo and setting new standards. Every business is becoming a software company, and every software company needs a database. MongoDB is positioned to be the database of choice for these companies. As AI accelerates, MongoDB's role as the data engine only grows. The demand for flexible, scalable data solutions will continue to rise. Investing in MongoDB is a bet on the future of application development, flexible, scalable, and cloud-native. These attributes are essential for modern software development. The leadership team has a strong track record, successfully shifting to a cloud-first model with Atlas. Their vision and execution have been key to MongoDB's success. With a market cap of $17.76 billion, EPS of 83 cents, and annual revenue of $2.01 billion in 2024, MongoDB has established itself as a prominent player in the database software space. And yet, the company's stock, currently priced at $219.05, sits nearly 70% below its fair value estimate of $368.67, signaling a potential opportunity for long-term investors. MongoDB recently announced that it will report its Q2 fiscal year 2026 results on August 26. This upcoming earnings call is expected to shed light on the company's current performance and its forward-looking strategy, especially important as investors try to gauge whether MongoDB can bounce back. In the meantime, Wall Street sentiment around MongoDB remains relatively upbeat. The company was recently highlighted in analyst reports as one of the top growth picks in the tech sector, further strengthening the bull case around its future prospects. One of the most notable developments is MongoDB's intensified focus on subscriptions, especially in enterprise and AI-driven markets. This strategic shift aligns with broader industry trends and may help MongoDB grow recurring revenue while attracting more high-value clients. If executed well, it could be a powerful driver of long-term revenue growth and profitability. Still, the outlook isn't without challenges. While investor optimism exists, concerns remain about cost control and execution risk. The next earnings report will be a key moment for the company to either reaffirm its upward trajectory or face renewed skepticism. In the coming weeks, the market will be watching MongoDB's strategy closely, particularly how it balances expansion with operational discipline. For long-term investors, MongoDB offers exposure to the foundational software layer of the digital economy. This makes it a compelling investment opportunity. The path won't be linear, but digital transformation and AI are powerful tailwinds. These trends will drive demand for MongoDB's solutions. Watch Atlas revenue, customer growth, and retention. These are the key health indicators. Monitoring these metrics will provide insights into MongoDB's performance. As long as those metrics are strong, the MDB thesis holds. Investors can have confidence in the company's long-term potential. MongoDB is a key player in the data-driven future. Its innovative approach and strong market position make it a company to watch. Two companies, ARM Holdings and MongoDB, are powering the AI revolution from the ground up. ARM is the architect, MongoDB is the data engine. Both are essential for the next wave of intelligent technology. Together, both companies are navigating critical turning points, one in chip design and AI infrastructure, the other in enterprise software and subscriptions. Each company is trying to prove that it can adapt, innovate, and scale in increasingly competitive markets. Whether they can meet the moment will determine their trajectories in the tech landscape ahead. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Don't forget to like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.